Home prices take another drop. Hey everybody, you're watching Bull, Boom, Bear, Bust. We're back with a housing market update. This is Housing Bubble 2.0. And I wanted to make sure that I brought some charts to everybody here today. So therefore, no camera on myself. It's going to be about the charts and the data and the numbers as we unfold what's happening in the U.S. housing market. And yes, home prices last month took another drop from the month prior. So we have the October numbers. They are out and they are final, and we're going to give you the scoop on it today. Before we get into this, please make sure you like, subscribe to keep this channel alive. I know almost half of you that tune in, according to the analytics, are not subscribed. I appreciate you being here, but please subscribe. It really helps the channel, and it'll ensure that I'll bring you more updates as time goes on. Let's get into it right now. Let's go over to a headline out of CNN. U.S. home sales fall for 9th month in a row in October. And what's that doing to prices? Well, let's take a look. Well, prices are down quite a lot. In June of this year, nationwide, the median home price peaked at $413,800. In October, the median home price nationwide was $379,100. Now, this article points out that the home prices are up 6% year over year. Yes, that is true. But look at the big drop since the peak in June from 413 down to 379 nationwide. That, my friends, is a drop of $34,700 in just 4 months. So from June to October, $34,700 price drop. That is huge. And actually, that's bigger than any drop that we saw in the previous housing bubble. Now, let's put this into perspective. $34,700 in just 4 months. That means in a year, we could see the median home price drop by $100,000 or be $100,000 less than what the peak was. And if that were to happen, that would be about a $313,000 home price, and that's the median price nationwide. That would be pretty amazing. And if we do see that big of a price drop, then even with higher mortgage rates, even if mortgage rates don't drop, if they stay where they're at now or go higher, you're going to see more affordability come back into the housing market, because then the home prices are finally down far enough to where people can actually afford the payment even with a higher mortgage rate. Now, not everyone, but it will bring a lot more buyers that are on the sidelines into the markets. Recent article out of CNBC, we also see that investors are pulling back on their purchases. In fact, investor home purchases dropped 30% as price increases slow down. So let's hope this continues to allow other people or owners to actually buy a home. But we know that investors are looking at their return, and if people are so broke and tapped out and so far in debt that they can't pay rent, well, investors need to be very careful about buying a property at these current prices, hoping to turn around and rent it out. Remember, when the last housing bubble went bust, rent prices also went down at the same time because the entire economy was coming down at the same time. Remember, home equity is a real big factor in the confidence of the consumer. And when consumers lose home equity, they're more likely to drastically pull back on their spending. And that bleeds over to the broader economy, because our economy here in the U.S. especially is mostly made up of people spending money and taking on debt. In fact, another recent article out of CNBC points out how much equity U.S. homeowners have lost collectively. Here's how much equity homeowners have lost since May. Homeowners' equity peaked at $11.7 trillion as of May, and that was when home prices had jumped 45% since the start of the pandemic. However, since May, about $1.5 trillion has vanished, according to Black Knight. The average borrower has lost about $30,000 in equity. Now, let's go to Fortune here, and this shows us the year-over-year home price growth. And if we look back to late 2019, going into 2020, we were approaching zero growth. We were at 1.8% year-over-year. October 2019, 1.2% year-over-year, 0.8% year-over-year in October. October, then November was 0.6% year over year. And then what happened? Well, 2020 happened, the lockdowns, the moratoriums, the eviction cancellations, all the stimulus programs, all the forgiveness programs, the pausing of over 30 million people, utilities, the pausing in car loans and student loans, right? All those things that didn't have to be paid back, combined with the enhanced unemployment benefits, the rock bottom interest rates, they lowered rates back down to near zero. We took away the reserve requirement from the banks, and what happened, of course, the rest is history. We saw that prices took off and skyrocketed, and this was a manipulated rescue of the housing market. This was not organic growth. This wasn't based on actual long-term increases to income. It was a lot based on the things that we laid out and temporary boost to incomes. People were using their extra income and the fact that they didn't have to pay their rents and they didn't have to pay their mortgages in many cases. They used that to make more investment in real estate. We also know that investor purchases really ramped up during that time. People looking to become their own boss, to become an Airbnb landlord, and many people went out and bought homes specifically to rent out and to Airbnb. So it's my estimate that if 2020 wouldn't have happened the way it happened, we would have already been in negative territory by the end of 2020. Of course, we saw the big surge here, and even as of October, we're still up about 7.9% year over year, and this is based out of the Zillow Home Value Index. Now, CoreLogic is out there with the markets that are most likely to drop in 2023, or the ones that are going to drop the hardest. And we see it's mostly coastal cities along the coast here, even on the East Coast, and especially on the West Coast. Right, but also in many inland markets like Colorado, Utah, Nevada, Arizona, and Idaho, especially Boise, Idaho, one of the biggest run-ups in home prices that we saw. Actually, the biggest run-up in home prices was in Boise, Idaho. And in fact, I just talked to a client from Boise, Idaho earlier today, and they were underpinning my belief in our analysis here. And they said they see California plates everywhere they go. It seems like 1 in 5 cars, according to this person, were California plates. So all these regions in red are given a risk analysis of a very high chance of home prices dropping. Well, it's not going to be just very high. It's going to be definitely dropping, in my opinion. And this real estate correction doesn't show any signs of slowing down. In fact, in October, pending home sales posted a record drop as deal cancellations and price cuts hit record high, and that's per Redfin. In fact, pending sales dropped 32% year over year last month. That was the largest decline since 2013, and that was about nearly 60,000 home purchase agreements fell through, and that equaled about 18% of homes that went under contract. Also, almost 24% of homes experienced a price drop, double the rate of just 1 year ago. So hold on to your wallets, folks. We have a long ways to go in this housing market correction. And I'd like to hear from you down in the comments. What do you think about the price correction so far? With the nationwide median home price now down nearly $35,000 just since June, from June to October. Pretty amazing, and it's likely going to continue. Thanks everybody for watching and support. Be well. Big love. Bye for now. Keep stacking. Peace.